Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren.
Hey everybody.
Hey, happy holidays Lauren, happy holidays everybody.
Yes, happy holidays.
I thought it was interesting, Lauren, I found an article in the Seattle Times business section the other day, and they were talking about what investors are doing with their mutual fund investments, where they're moving their money from and where they're moving them to.
Okay.
Okay. You know, they talk about 2000 to 2010 as sort of the lost decade for stocks.
That's right. Right.
But really what they're talking about is U.S. large company stocks.
Right.
There were actually several asset classes that performed quite well during that decade, as we both know.
Right.
One of them was emerging markets.
Yes, that's true.
Before I get into what the general investors are doing, kind of visualizing back to the end of 2010, what were some of the asset classes that we rebalanced from and into what? Because we had a pretty good run where the stocks came back pretty strong.
So when we were rebalancing at the end of 2010, we would have been selling some of emerging markets.
Right.
Actually, we've been selling a lot of emerging markets because that was one of the best performers. Probably international small companies, U.S. small companies. Most of the riskiest and highest returning asset classes had done spectacularly well in 2009 and 2010. So those were the ones that we were selling.
And we typically rebalance into short-term bonds and maybe some of the U.S. categories, but basically we kind of rebalance back into fixed income.
Right. Yeah. Exactly.
So here's what happens since January 1st of 2011. First of all, investors have taken out year-to-date $173 billion from money market funds.
Interesting.
Yeah, that was interesting. And here's where they moved their money. First of all, they put $45 billion into international stock funds, including emerging markets.
Oh, okay.
And what's happened to the international emerging markets this year?
I think about the worst performer. I think emerging markets have been the worst performer of the entire year.
Right. So then what they did is in just the month of November alone, they took out $2.6 billion from foreign stock funds just that last month. They're going back now. They're taking it out because of the bad performance.
So at the beginning of the year, they were putting tons of money into emerging markets.
Right.
Then when it went down, now they're taking money back out.
They also have taken out overall from U.S. stock funds $65 billion from stock funds this year. They're taking them out just this last couple months.
Right.
Now they're moving them into intermediate and long-term bond funds.
Okay.
So, what do we do different?
Pretty much the exact opposite. We're moving money back into the stock market since the stocks have done poorly the last couple of quarters, or at least not gone very far. We're certainly selling money out of short-term bonds and other kinds of fixed income. We don't really own long-term bonds usually. Because
there is a danger with long-term bonds, even though they're a good performing asset class this year because of the U.S. dollar strengthening. There's a danger with inflation cropping up and interest rates going higher.
And people look at past returns and they see that long-term bonds have done very well over certain periods of time. That's because interest rates have been dropping now.
Right.
Really, literally, for 30 years. We've had a 30-year bull market in bonds because interest rates have dropped from the 1982 or so to the present. And I don't remember exactly what they were, but interest rates were in double digits, in the early 80s. Now interest rates are getting about as close to zero as they're ever going to get. You're not going to see us go from zero to something negative.
Right.
That isn't going to happen. So, it's like you look at the past and you try to think that this is what's going to happen in the future, but with certain things, what happened in the past can't happen in the future. Right. It's not just that it doesn't predict it. Right. It literally can't happen again. But this is what often happens.
Right. So then kind of moving ahead and projecting what's going to happen in the future, what I worry about for the investors that are chasing returns, and really that's what they're doing, they're chasing returns, that they're going to potentially be at risk for capital depreciation in their bond funds. Then they're going to say, okay, now we're going to put our money, and then by that time probably stocks are going to go up, and they're going to chase that. And then the other thing I noticed, which is not in this article, is there's been an issue because of the U.S. dollar strengthening that gold is taking a beating in price.
Right.
And so I remember just back in July they were saying that the U.S. dollar, because we can't get our deficit under control, is not the place to be.
Right.
And
well, this is the most perfect example of why no one predicts the future correctly. Right. I mean, at the beginning of this year, nobody believed that the U.S. dollar would be where people were fleeing to.
Right.
Nobody thought that was going to happen.
From Europe.
However, somehow or other, politicians in Europe made politicians in the United States look like fine, upstanding citizens, and as a result, the U.S. looks like the safe place again. You cannot predict what's going to happen.
So just to finish up this video to give you some hope about how to invest in the future, if you're talking about long-term investing, what are the simple rules of how to invest? First of all, diversify.
Diversify, yes.
So all these asset categories we're talking about, have those included, and then we want to buy low and sell high. And
through rebalancing.
Exactly, through rebalancing. It seems like what the common investor is doing is they're doing the opposite. They are picking among different asset classes, so they're not diversifying. They're buying high,
right,
and selling low. So if you'd like help in making sure your portfolio is properly positioned for whatever could happen in the future, please let Lauren or myself know, and we'll be happy to help out. Thank you very much, and have a great week. We'll talk to you soon. Bye now.
See you next time.